In the past 6 years, the US has been through an oil production boom thanks to fracking. Advances in hydraulic fracturing, to give it its proper name, and horizontal drilling have made it possible to extract oil from shales and similar rocks from which it doesn't flow easily. The result has been a surge in US oil output, which rose by more than 4 million barrels a day between 2010 and 2015. The shale boom was encouraged by high oil prices that were steady in the region of $100 per barrel and seemed likely to stay that way. That encouraged the small and mid-sized exploration and production companies that led the US shale boom to take on ever higher amounts of debt to finance their drilling. It was a pattern that was repeated even in countries that didn't have shale booms. The world's largest oil companies' investment boomed as their costs rose over the decade to 2013, and they took on more debt to pay for it. But then the assumptions that underpinned the build-up of debt turned out not to be true. Oil prices have tumbled all the way back down to where they were in 2004. But most of the debt built up during the boom years is still there. The slump in oil prices has made investors nervous about energy company debt. Yields on high-yield energy company bonds have soared. This chart shows the spread above benchmark US Treasuries. Default rates in the oil industry have risen sharply and are expected to rise even further. There are many companies that are teetering on the brink. That has a knock-on effect on other markets. Investors who've made losses or worry about making losses are unwilling to take on any more risk. That affects stock markets and bond markets worldwide. The standard model generally suggests that lower oil prices are good for the world economy because they transfer real income to consumers. The energy debt overhang means that further falls in oil prices could be damaging. If prices continue the recovery they've been on since January, that might be the best outcome for everyone. Ed Crooks for the Financial Times.